Okay. Hello. Good evening, everyone. Welcome. Thanks for joining us this evening and taking a bit of time out of your Wednesday night. Of course, the webinar this evening is going to be mainly focused around the proposed changes to the NHR regime or the NHTR regime, the non-habitual tax residency regime in Portugal. Now, of course, there'll be some of you on the call thinking, well, those changes maybe aren't going to apply anymore because of the news last week. For anyone who hasn't seen the news, last Tuesday on the 6th of November, sorry, on the 7th of November, I should say, Antonio Costa decided to resign based around some pressures around some lithium and political corruption. We'll not get into that. Most politicians would have issues if you look deep down enough. But the main thing was he resigned as Prime Minister of Portugal. Now, what that actually means is that his decree, his bill, public state bill, to end the NHR regime in 2024 expires with him. So you can all leave the call now. That's the update. No, I'm joking. Stay on, because there's still going to be key updates around what that actually means, when the NHR is likely to actually be stopped, or the impact that's going to have on individuals, how you can apply for NHR if you're on the call and not currently on an NHR. There's some key facts around that, and I'd still very much expedite that process, given the fact that it's still plausible it could end in 2024, or 2025. There's also some key planning techniques that I'm going to talk to you all around, how to structure your assets whilst you're on the non-habitual regime, and this will be mainly focused to the individuals on the call who are on an NHR already, whether that's 0% tax code for 10 years or 10% tax code for 10 years, depends on when you were on pre or post March 2020. But there's going to be a lot of key techniques. So I think there'll be something on the call to cover everyone. It won't be an overly extensive presentation. I'll get through this. And of course, if you have any more questions at the end, we will not actually have questions at the end of this presentation, but you're more than welcome to send emails or even drop me a call or a message with more questions, or if you'd like an initial short conversation around some of the topics covered. And that's the structure. So it's going to be a short introduction to myself and Skybound as a company, move on to Portugal, NHTR, and then also talk about some financial planning around NHR there as well. So look, some of you in the call are probably wondering why a Scottish person is advising international workers or expats living in Portugal on their finances. So let me explain. I am from Glasgow, from Scotland. All my professional exams, I'm a Chartered Fellow for the Chartered Institute for Securities and Investments, CISI in the UK. But although all my professional exams are done in the UK, I've actually not really done much advice in the UK. I now have clients who are back in the UK, and I do a lot of repatriation and planning and income planning when they're back. But it's important you understand that 10 years ago, I left the UK straight after my professional exams because my passion always lay with cross-border financial planning. Cross-border in the sense that when I was working closely with my director at that time, I loved the intricacies and the technical side behind an individual who perhaps had worked in multiple countries, let's say France, Belgium, US, and Middle East, and they're actually part of social contributions in these countries. They've got assets, property, cash, banks, pensions dotted around, and it's a case of understanding how these things come together and how the cross-border taxation and how the investments work from different countries, varying from country to country. So that's where my passion always lay. My passion took me to Belgium, where I was doing a lot of advice, not just in Brussels, but also in Paris and Toulouse for about 3-4 years. I then moved down south further south, I should say, to Geneva. I headed up the office there actually for 4 years, and I covered the full region of Switzerland, still keeping my clients in France, of course. And then, very circumstantial actually, I had a lot of clients, senior clients, category 3 clients who started to retire or started going to an income drawdown stage, away from the accumulation, and they moved to Portugal. Obvious reasons behind that, of course, which we'll cover in the presentation, is the NHR. So I end up with this pocket of clients, mainly in the Algarve, but also dotted around in different places in Portugal, which has kind of taken me over the last few years to the region as well. So I thought I'd put a bit of a focus on Portugal because I've got a lot of experience with it over the last few years, and a lot of experience with individuals living here with assets dotted around in different countries. Look, I work for a company called Skybound Wealth Management. Skybound Wealth Management are a UK-based financial planning company. I say UK-based financial planning because that's where they started 26 years ago. We've got offices based in Poole, in London Mayfair, and London Bridge, London City, and also further north in Sheffield. But since then, over the last 26 years, they've expanded globally. So we're in the US, Middle East, Europe, Switzerland, South Africa, and we've also got operations in Australia, albeit with a key partner there. The only thing, there's some facts there at the bottom. I guess it's important to highlight that Skybound Wealth are a medium-sized entity. You know, we've got maybe 200-300 staff globally, 10,000 plus clients globally. We've got about 1.1 billion USD under management, and a lot of qualified advisors across different continents. But look, I think the only thing that really is important for me to highlight on this call for you, for most of you in attendance, is the fact that we are regulated locally in every jurisdiction that we operate. So for example, if anyone on this call is a Swiss resident or even got assets in Switzerland, and we're looking at some financial planning in Switzerland, whether it's pillar 1, 2, 3, private banking, retail banking, or investment solutions, or anything of that nature, that would come under our regulation ARIF, which is where we're governed in the Swiss jurisdiction. Middle East, we've got the Insurance Authority and the ESCA. So Insurance Authority at the top here and ESCA at the bottom right. So both of those are dual regulations for insurance and financial planning and wealth management in the Middle East, the UAE. You've got the UK here, the Financial Conduct Authority, FCA. You've got the SEC from the US on the bottom left, and you've got MiFID II, which covers all of Europe, every country in Europe. Now, it's important that when you're speaking to advisors, if any of you on the call here have assets in multiple jurisdictions, and you're thinking about consolidations, drawdowns, how to structure your assets from an income point of view monthly, how to bring these things together, it's really important whatever advisor you're speaking to carries regulation in multiple jurisdictions, because if you carry one regulation in one jurisdiction, guess what? That confines you to a restricted access to a restricted range of investment solutions and wealth management solutions. However, if you're dual regulated or multi-regulated, what it is, it opens up the doors in terms of providing access to your European solutions, but also UK solutions, existing Swiss solutions, Middle East, and so on and so forth. Look, as a company, before I move on to the next section, one thing I want to highlight is that Skybound Wealth Management, we are an independent institution. What that means is that within the corporation of Skybound Wealth, we don't have our own banks, pensions, investments. We don't hold clients' money specifically. What we are is we're an intermediary whereby we have terms of business with, say, 200 companies around the world. And those companies will range from retail banks to private banks to insurance companies to pensions in Europe, Switzerland, UK, US. They'll range from property developers, legal, tax specialists, investment platforms, life assured vehicles, and so on and so forth. So we've got terms of business with all institutions to really develop a bespoke plan for individuals and ensure that individuals have access to all the institutions they need, because depending on which country you're in and depending on where your primary tax resident, each country and each tax residency actually treats assets differently. So it's really important that your structure and your assets are structured in a way which is tax optimized and best optimized for the country you're likely to be in when you draw down. Right, general advice disclaimer. It's really important to highlight here that the information I'm giving you all today on this call should not be constituted as advice at this stage. It should be very much informational purposes for you to look at your own position, assess your own position, and then seek advice with myself, of course, or with another advisory institution thereafter. The reason I say that is because I don't understand each individual circumstances in detail. I don't understand where your nationality, dual nationality, where your citizenship, where you're domiciled, where your primary tax resident. I don't understand all of your assets and your circumstances around marriage, dependence. So it's really important that I understand all of these elements before advice is actually given. The second part I want to highlight is that I am not a tax specialist or a tax advisor, which might sound a little bit ironic given the presentation is centered around NHR. But one thing I'll say is that my job is wealth management in terms of structuring assets around your position and your tax position. As an independent company, which I mentioned previously, we have key partnerships with tax companies and tax specialists in every jurisdiction that we operate. Around 25, 26 different companies around the globe. All of the advice that I'm giving, all of the information, I should say, that I'm giving on this presentation is based on recent case studies that we've had. It's based on recent client circumstances. However, one thing I'll say is that if you did want to approach advice, the first thing we'd do is actually seek the tax advice, but I'd bring in one of my partners, and then the investment and wealth management advice would then follow thereafter. Some of the key partners that we work with: TFO, Atlantic Property Tax Consultants, Abro and Marquee, which is one of the key companies we use for helping people with NHR applications, and KPMG there at the bottom, who tend to be used for more complex cases, because naturally they're the size of the company and the fees that they start on are a lot higher. But we've got advisors to fit all clients' circumstances. Right. That was a brief introduction as to myself and the company. Portugal NHTR. Right, a little bit of history for anyone that doesn't know. A decree in 2009 was launched in September 2009, which was a more advantageous tax regime for individuals who have not been tax resident in Portugal for 5 years. So the main purpose of this decree in 2009 was to bring in a tax code which would attract professionals from over the world, highly qualified and high net worth individuals and high net worth retirees. Why are Portugal doing that? Well, the answer is fairly obvious, in the sense that even still, most Europeans still go to retire. I guess, talking about it in numbers, more people still move to places like Spain, the Balearic, and even Cyprus to an extent than Portugal. So it's a way of the Portuguese economy trying to attract more wealth and retirees into the country. In order to apply for the NHR code, you have to have a home or an apartment in Portugal, either owned or rented. Rented's fine. You have to apply for tax residency in Portugal with the City Hall. You must spend over 183 days in the country to be confirmed as primary tax resident of Portugal, and you must not have been resident in Portugal for the last 5 years. Very important part of that on part 4. What does that give you? It gives you a tax code whereby all of your foreign income or foreign investment income coming into the country is fixed at a tax rate of 10% for 10 years, and that 10 years follows the approval of the code. So if you apply today, that would run for 10 years thereafter. That's post-March 2020. For any lucky individuals on the call who may have applied pre-March 2020, you have a 0% tax code for 10 years following the date of your approval and your NHR being in place. Now, look, there are exemptions to this. I guess I'm going to split it into 2 categories. You've got individuals who moved to Portugal who are still actually working. And the exemptions there are that if you're working with a country, you're subcontracted from a country, let's say that your previous employment's in Belgium or France, and you move to Portugal, it depends on the structure of your company or your employer at the place of where they're based. Because if they're still paying social contributions and taxes locally because you're not on a kind of more permanent contract in Portugal, then unfortunately, there's still going to be taxes to pay in that country. Now, it depends on the company you work for and depends on your structure, but majority of cases would be that you're localized in Portugal and you've got a more favorable tax regime. Of course, if you're retired, which is category 2, you're not working or accumulating wealth. It's a case of structuring your assets and pulling out on a lower tax code over that 10-year period. Income generated locally in Portugal. So if you're receiving an income locally in Portugal, tends to have a flat rate of 20% for professions which are deemed in a specific professional criteria. Now, there's a long list of these. You can actually just pop onto the website and have a look. But, you know, doctors, experts, technical experts, managers in certain industries can apply for a lower tax code of 20% on locally sourced income as well as foreign income. Right, so the presentation, I felt it was a good time to put it out here because, of course, Antonio Costa confirmed that he was going to end the regime in 2024. What that meant is that no applications would be entertained from the 1st of January if the individual was not actually primary tax resident in Portugal. So that put a very hard deadline on things for individuals who perhaps have moved to Portugal for some reason, not quite applied for NHR or not quite got round to it. That put a very, very tight deadline on things, because the 1st of January is not far away and there's a number of steps that have to be satisfied, which are on the next slide. However, of course, with the announcement last week, which funnily enough, I actually done this presentation on a seminar event in the Tivoli Hotel down in Villamura last Tuesday. Funnily enough, the announcement was actually that afternoon, the afternoon of the event, which was quite interesting. So listen, on the next slide, these are the things that had to be done before the Prime Minister resigned. These are still the things that have to be done. So my advice to everyone on the call, if you've not already applied for NHR, is to do it as soon as possible, because the applications were piling up. Effectively, what will happen is, if the next election, if from what I understand, because I'm not an expert in Portuguese politics, but from what I understand, on the next election, if the socialist government wins again, the next Prime Minister will just relaunch the decree to end NHR. And that would then take effect in 2024, or perhaps coming into start of 2025. So it's still not a lot of time, to make sure things are in line and all your ducks are in line, but more time than we had last Tuesday. So key things that you have to do, steps to obtain your NHR. The first one is, for EU citizens, the first step is to obtain a Portuguese tax number as a non-resident. The second thing is to buy or rent a property in Portugal as your main residency. The third part, apply before the City Hall of the area of your residence to the certificate of EU citizen residing in Portugal. This step needs to be completed by each person physically at the City Hall. So if you're married, in a partnership, a civil partnership, then you should both attend in person. The fourth part is you then have to change your primary tax residency before to Portugal. Those were the 4 steps that had to be completed before 1st of January 2024 in 2023. Then number 5, apply for a passport to the tax authority's web portal and register as an individual as an NHR until March 2024. Ignore that statement at the bottom there, which is bold and highlighted, underlined, because that's the part that expired with the Prime Minister resigning. Right, that's all well and good. You can apply your NHR, apply for your NHR independently as an individual. Given us a bit more time, that might appeal to you. If you want help with it, assistance with it, of course, just reach out to us, because we work with key tax specialists who I mentioned before in a few slides before. They work on an hourly rate, typically kind of €150 an hour, but they'll process the whole application for you, walk you through it, make sure it's swift, clean, easy, and it's done in a timely manner. And that was a very handy process to have, given the timelines, but it's completely up to you on the call if you need that assistance. Okay, step 3. There'll be some people on the call who are already on an NHR, or for some reason, maybe in some cases, they don't think it's applicable at all. This part is just some financial planning around a non-habitual regime. This is important, because it's very important to understand that when you leave the NHR regime, if you're still residing in Portugal, that you then go into a normal tax code in Portugal, whereby your rates are subject to the standard bands of 0% up to 48%. That was 48% as the high income tax band. So this section is going to focus on key things to bear in mind, key things that you should be looking at to include, depending on whether you're planning to retire in Portugal or planning to leave again before your NHR is up, which is another fairly common step that my clients have taken. Okay, so something that's important to highlight here is that, well, just some key tax rates in Portugal, really, without going into this in too much detail. Look, your marginal tax rates in Portugal, I mentioned 0%, forgive me, it's between 14.5 and 48%. What that means is that if you're on a high income or generating a high income from your assets, you know, let's talk 10,000 a month, 10,000 euros a month, you're immediately going to be straight up into that 48% bracket, working your way up. There's also a solidarity surcharges, which apply 2.5% on taxable income between 80,000 euro and 250,000 euro, and a 5% additional surcharge taxable income exceeding 250,000 euro. Flat rates apply. Typically, your interest and dividends at a flat rate of 28%, capital gains 28%, and then your rental income is taxed at a flat rate of between 10 and 28%. And this is what it looks like. So from my experience, I'd say it's probably 50-50 to be honest. I've had clients move to Portugal on their NHR. They've spent 4 or 5 years there. They've actually pretty much withdrawn or reinvested a lot of their holdings, which I'll come to in a moment, and then they actually leave again. They move back to Switzerland or Bahamas or somewhere of their fancy thereafter, even the UK, of course, in some instances, or Europe, France, Belgium. Look, there's two sides to this. I'm going to approach, there's some of you on the call who perhaps are very comfortable in Portugal, no plans to leave. For you individuals here, it's really important to understand that whilst you're on the NHR, your foreign income coming in is going to be very efficient because it's going to be either taxed at 0% or 10%, which is great. But as soon as you leave the NHR, whether that you've got 3 years left or 5 years left or 7 years left or 10 years left, your tax rate's going to go up to, of course, the normal bands here, which are illustrated from 14.5 to 48. This is important because if you think about it, I can't speak for everyone's assets and everyone's context, but let's say you've got a private or personal pension. Let's say you, let me talk to the people who maybe got a self-invested personal or a private pension in the UK. If you've got a private pension or personal pension in the UK, you've got a vehicle there with a residual value and you're drawing down an income, let's say 10,000 a month. That 10,000 a month is great because you're either going to have net 10,000 or net 9,000 whilst you're on the NHR per month. But as soon as you leave that, you're going to see a really hefty sum taken off that monthly income. Anything above that 78,000 mark a year is going to be taxed at 48%, almost half of your income. So that 10,000 a month, I've not got the exact calculation, but you're going to see maybe say net 6,000 a month, maybe a little bit higher, 6,500, depending on the allowances you've got. So you can see that the cost becomes a lot higher from a tax perspective. So the question is, how do you structure assets whilst you're on an NHR, if you're planning to stay in Portugal, to be best structured long-term for your eventual drawdown? For anybody that's not planning to be in Portugal long-term, I'll come back to you in a few slides. In order to explain this as best I can, it's important I highlight the difference between asset classes. So not investments, not equities, stocks, bonds. I'm talking about asset classes in the sense of, do you hold a bank, a private bank? Do you hold a pension? Do you hold a UK or European pension? Do you hold a stocks and share investment account? Do you hold an online platform, investment platform? Do you hold a life assured investment vehicle? These are holding vehicles, custodians that you can use for investments and for drawdown. Different types of custodians. Now, it's really important. We're not going to go through all of them today. We can do that obviously on individual meetings, but it's really important to highlight the difference between a personal investment vehicle and a pension. The reason for this is because personal investment vehicles, whether you hold a Bendigo bank or a BBVA bank or a HSBC with a stock in it, that's a personal investment vehicle. If you hold a key trade account or a Swiss quote account or an online platform where you hold investments, trading 212, anything on your mobile phone, that's a personal investment. These are just online vehicles or banks which hold investments for you. Now, with a personal investment, all of your capital that's invested into the vehicle is not taxable when you take it back out. Why? Because naturally, you've earned your wealth, you've paid tax on that wealth, and you've reinvested. So that your capital you've invested into the personal vehicle is not taxable. However, what is taxable is the growth that you make on that personal vehicle above your capital. So for example, if you've invested €1 million and that €1 million turns into €1.5 million over a 10-year period, that €500,000 would be subject to capital gains or income tax, or one of those, depending on the structure of the holdings within and the structure of the custodian. The €1 million is not taxable. Pensions on the right-hand side are an asset class whereby your personal contributions, employer contributions, and the growth that you make on the pension are not separated from a tax perspective. Why is that? Well, because most of the time you get tax allowances paying into a pension for most countries globally. So what that means is that for that same €1 million that I'm talking about, let's say that's in a pension and not a personal vehicle, that €1 million turns into €1.5 million over a 10-year period. There is no differentiation between the 1 million and the 1.5. The full 1.5 million, the full capital pot, is taxed as income when you draw down from that pension in most countries, all the countries we're referring to. Now, what that means is, some of you may be starting to click on here, is that if your wealth is quite heavy in pensions, that's fine when you're taking the money out on your NHR, but as soon as that NHR runs up, that full pot you've got, if you say, look, I want to take out that full 1.5 million, if you had a flexible personal pension in any country, if you had the ability to take that 1.5 out, guess what? If you do it after your NHR, boom, 48% tax is going to be a majority of that pension. However, if you do it before your NHR runs up, you're still going to benefit from that advantageous 0% or 10% tax code. So some planning to think about here, and I say this with caution because it's not necessarily the right thing for everyone, because in some cases pensions have IHT allowances or benefits for succession planning. Sometimes they're not as flexible as I'm making out, but for majority of cases that I've had, with a bit of planning around the secondary part there, which is normal succession and IHT, I tend to find it moves in priorities. But what you should be aiming to do if you're planning to be in Portugal long term is expedite with the withdrawals from your pension and make sure that's being reinvested into personal vehicles, because if you can pull out that 1.5 before your NHR runs up, reinvest that into a personal vehicle, all of that is now considered tax paid because you've done it on your NHR. All right, you might have to pay 10%, but guess what? You're not going to have the 48% band thereafter. So 150k and 1.5 million, you know, might sound sore, but in the grand scheme of things, it's an extremely, extremely advantageous tax rate. What that means is the residual after 1.5 or 1.35 would be invested into a personal vehicle, and you'd only then pay tax on the growth thereafter, which would be 28% on growth after. So if you're, you know, 1.35 or 1.5 then turns out to 1.7, you're only paying 28% on 200,000 or 350,000. Huge difference between the both. So these are some of the things that I wanted people to think about. We obviously don't have enough time to cover all asset classes and all jurisdictions and all tax areas, but something to think about. Really important, not just for people to apply for NHR if it's advantageous to them, but also to make sure they're making the most of their time on NHR to structure their assets right and accordingly. We've not even spoke about property and other assets and holdings, but these are things that I can talk to you about on an individual one-to-one meeting if you wish. Okay, in addition to this, I just wanted to cover the third point here at the bottom. There's also another planning tool which should be utilised for not just for people drawing down pensions on NHR or drawing down assets, but anyone who's actually got liquid savings or liquid holdings in Portugal. So there are vehicles in Portugal, and I'm not going to try to pronounce this because I almost embarrassed myself last Tuesday, but they are called ICAEs. And that's the term there. They're instruments which are recognised in Portugal and compliant from a tax perspective. They tend to be kind of investment platforms with a life assured wrapper. Now, what they actually do is if you hold these vehicles for 8 years, you get a 60% tax exemption on your gains. 60%. Now, what that means is that rather than paying 28% capital gains tax on the growth that you make, let's go back to the example, 1.5 million turns into 1.7. Rather than paying 28% on 200,000, which is your gain, you'd only pay 11.2% on the 200,000. So again, further tax planning. For me, my wealth management, my planning always works in stages. Understanding your position, where you're likely to be, what jurisdictions your assets are in, bringing in the tax advice and understanding what your options are and what the plan should be. Then it's understanding what your key priorities are. How much income do you want? How important is your income compared to succession planning? And then it drips down into what vehicles now we structure things and what ones we should reopen up. Okay. Finally, for anyone who is intending to leave Portugal, I just popped some countries on here. Portugal's at the top left, of course, which we've covered in a reasonable amount of detail today. You've got Spain in the centre for anyone looking to retire in Spain. Look, again, I'm not going to go through all these in sequence, but little facts for you. Little facts for you. Spain has a cantonal tax system, very similar to Switzerland, actually, who's just on the right-hand side of it. Cantonal tax in the terms of that each canton, Spain as a country split into different cantons, and each canton has its own governance and taxing rights, whether it's wealth, income, capital gains, tax within that jurisdiction. Of course, the more central Spanish-heavy citizenship, like Madrid, has more effective tax rates and lower tax rates than perhaps the south of Spain, because that's where a lot of retirees go. So some key things to consider there. Spain also has a very favourable savings income tax rate on annuities, and you can structure pensions in that manner. Some other key things as well, just you've obviously got the Modelo 720 reporting requirements and things of that nature as well. So there's key things to look at in Spain. Quite good for planning, to be honest. There's quite a lot of things you can do to plan efficiently in Spain, particularly if you're quite flexible over your primary tax residency. But speak to us if you're planning to go back to Spain. Switzerland, similar in ways. Each canton is split into, it's got its own sovereignty and its own tax rates. So for example, Geneva's compared to Zug, it's got much higher tax rates on every aspect, income, wealth, and gains. So it's really important to consider there. Obviously, for Switzerland, you've got your pillar systems, pillar 1, 2, 3, that carry tax efficiency and tax efficient contributions. It's obviously quite heavy on private banking. So for any category 3 clients, category 3 for me is high net worth. It's quite an attractive jurisdiction because they have a lot of advantageous services and Lombard loans and other things you can use for tax planning and for wealth building in Swiss. The UK is not split into different cantons. It's pretty much Scotland, Wales, and the UK. Scotland, Wales, and England have slightly different tax codes, but as a rule of thumb, it's all fairly similar. UK, look, you've got your pension systems, which are tax efficient in the UK. You've got ISAs, self-invested personal pensions. Trust planning is quite a big thing in the UK as well, given how heavy inheritance tax is in the UK. 40% above your nil band rate. But there's a lot of planning you can do in the UK. There's a lot of kind of vehicles, different instruments you can use. A lot of people use limited companies as well, and different things like that, which I'm not too heavily in, but we've got partners there who help. Germany, France, look, these other two, I put these in here. They're very restricted. There's not a lot of things in the middle which you can move or maneuver or adjust. It's very, very, very kind of black and white. Both kind of like quite socially run governments and economies. Not so attractive. Sometimes people don't have a choice where they're going to be primary tax resident retirement, but I always say to people, if you do have the choice or flexibility or luxury of travel, try and avoid France and Germany, because there's not a great deal that you can actually do from a structural point of view. However, Germany is quite attractive for people at the moment because real estate is a big attraction. But Berlin, Leipzig, these are some of the fastest growing jurisdictions, and they've got like below 1% vacancy rates across Germany, and quite reasonably attractive yields despite the caps on it. But the big attraction there is that you've got capital appreciation, which is quite attractive from these fast-growing jurisdictions. But also, if you hold the property for 10 years, there's no capital gains tax on the prop when you sell it. Big attraction for property developing and for people looking to build assets in Europe, not even Germany, just in Europe. France, you've got TTAs with obviously global countries, but one thing in France is you've got things called assurance vies. Assurance vies are quite similar to the ICAEs, which I mentioned in Portugal. They're kind of running an 8-year window. They're investment vehicles with a kind of life assured wrapper. They've got tax benefits for passing on wealth down to family, and they've also got tax benefits if you hold it. If you hold it for 8 years, your taxable gain comes down to 7.5%, but you've still got your social charges on top there, which take it up to around 23.1%, but still better than having just a normal investment vehicle with a flat rate of 30% tax, so to speak. Right. I'm conscious that I've spoken a lot. I'm actually going to finish up just here. These are just a whole list of companies that we work with. There's a lot more than this, but you'll know all the kind of big names here. My job initially is to understand your position, what your goals are, and then come back with a plan and companies to fit that plan. Tax planners, developers, investment companies, pension companies to fit your specific plan and where you're planning to be. If you would like to have an initial conversation, I don't charge for that. So I call it initial discovery meeting. Discovery meetings can be an hour long. You can tell me a little bit more about your position. I can tell a little bit more about, you know, what I think the best routes would be. And if that's of interest and of value to you, we can then discuss a service agreement and another meeting thereafter. If you want to reach out to me, these are my details. Ryan.Donaldson@skyboundwealth.com is my email address, and you've got my phone number there, which is a UK number, despite the fact I've not been in the UK for 10 years, but I do travel a lot in between. So it's +44 7718 622 753. Reach out to me if you'd like to have another conversation. And I hope everyone on the call found some value in today, whether it was on section 1, 2, or 3. And yeah, have a nice evening, everyone, and thank you for joining us again. Thanks.